good afternoon. For the benefit of time, I guess I could summarize our panel as I think the meme is tariffs on, tariffs off, which I actually indicate my age by that. So I have some blank stares, but that's a Karate Kid reference for those who get it. But I think we'll be missing some, I guess, points that are worth raising here in what has become, I guess, very topical as a subject of which is navigating the global financial landscape in 2025. Now, what do I want to do? I want to first describe this landscape because I think we need to. It's not a run-of-the-mill situation already. And maybe ask our panelists, which are at the forefront of the markets, to tell us how they deal with this and what do they tell their clients. The second part is to make it a little bit one step closer here to ask them what do they think about what all this means about Europe and Greece in particular. And then maybe to take a step back and ask the last question, which is whether this is the beginning of something really big or whether this is potentially noise. And there are two more big structural issues that we should be focusing on, and we're missing the point. So the next relevant point is who am I going to do this with? And in alphabetical order, I'm starting with Dr. Tasos Anastasatos, who's the Group Chief Economist and General Manager at Eurobank. He has had and he still has also academic positions. He has a very strong policy background, and he's also chairing the Economic Policy Committee at the Hellenic Bankers Association. Themos Fiotakis from London is the Global Head of FX and EM Macro Strategy at Barclays, with more than 20 years of experience in global markets, both in sell side and the buy side, some of them probably the hardest one with me at some point. Next, Dr. Nikolaos Panigirtzoglou, who is an MD at JP Morgan in the Global Macro Strategy Department. He is responsible for one of the flagship publications of JP Morgan Research, for those who know it, is called Flows and Liquidity. And he also has a very significant policy background, having worked at the Bank of England and more than 25 years of experience in global markets. And last but not least, Panagiotis Vlachopoulos, who is the Group CIO, the Chief Investment Officer of Piraeus Bank. Very long and varied experience on the buy side, in New York, and other places actually in the US, in London, and also continental Europe. So let's see if all of this actually has helped you to be able to answer the first question for me, which is, I'm going to ask you to pretend or to attempt to be some form of artificial intelligence being, maybe an early form, which let's call it pattern recognition. And because this is important, we're seeing a lot of moving parts in the market right now. And I want to ask you, how do you interpret them? Is this something that reminds you of something in the past? Can we make a reference to what we're seeing now in terms of the turbulence in the markets? Or is it something new? Or in other words, how would you describe it? I'm gonna start with Nikolaos.
Thank you, Yianos. First to say that whatever I say is it's not the JP Morgan view or opinion. It reflects my own opinion. I was in New York in the wake of the tariff announcement on April 2nd, and we were at a dinner with mostly hedge fund clients during the Trump speech. And they were all obviously shocked and saying, well, that's the Lehman crisis. Now, does it look like the Lehman crisis? Not really. I mean, during the Lehman crisis, we had credit blowing up. We didn't know which bank would be surviving tomorrow. So it's definitely not like the Lehman crisis. I think if there is some period in the past that there is similarity is the pandemic, and not because it's like the pandemic, but because we don't know how to deal with that. That's, I think, the similarity. We never had like a tariff rate increase in terms of the US effective tariff rate of 10 or 20%. We've never seen that. even the people that have longer experience than me. But what is similar is that we don't know how to deal with that. We don't know what is noise, what is signal, and more importantly, we are at the worst environment in terms of market liquidity and market depth. That means like small order flows can move markets by a lot. And we have a few metrics here that we are looking to like measure market depth or market breadth. And is extremely low, as low as it was in March 2020 for S&P 500 futures, for US Treasury futures, for the euro-dollar pair, not so much for the yen or sterling. And that means that we should be like careful with over-interpreting what we are seeing. And clearly the main topic of discussion this week has been the sell-off in treasury markets. There are various theories, margin calls, creating liquidations of treasuries, the Chinese selling treasuries. But to me, there is a very simple explanation, which was the explanation during the pandemic, that the small order flows, which on Monday in particular, intraday, are out like midday on Monday, when we started seeing the treasury market changing course. That's when exactly like our signals for like, momentum traders got like very extreme. So it is possible that we had some mean reversion flows coming from some hedge funds, trend following funds that got into like extreme levels, and then that propagated into relative trades that have been relatively crowded, like swap spread wideners and also short treasury futures, long treasury bonds. These two relative trades work only if markets function well and if liquidity is decent. When liquidity and market depth evaporates, these relative trades blow up, do not make sense, cannot be sustained, and it is likely that this week we are seeing a steady unwidening of these relative trades, which by definition will put upward pressure on treasury yields. So that's a simpler explanation than going to other theories that perhaps, like the Chinese selling treasuries, which, I know that people like this theory, they see that as a structural change, but I think we should not interpret every move or even actions by the Trump administration as a revolution.
So Nicola, let me, one summary and one quick follow-up question. Would you accept the fact that you're cool about it, or you're relatively cooler than what the market is looking at?
I think we have to be cool and calm and not extrapolate everything we see as some sort of permanent shift. And not only in terms of what we see in markets, but also in terms of what we see from US policy.
And the quick follow-up question is, in the pandemic, presumably, again, we'll find out years from now, it was not a man-made crisis, but this one appears to be a man-made crisis. Does this make any difference?
Yeah, I think...
Make it easier, in other words, because, man can change his or her mind, but...
It's different in nature, of course. I think, as I said, the similarities really, we don't know what
it's just the impact on the market.
It's just the uncertainty, That's the similar. Otherwise, it's totally different,
Understood.
Obviously, in nature. But I think the important point here is to also look at what Trump did, because I remember in that dinner, and that was very interesting. There were some guys that we're discussing why Trump chose two different dates for universal tariffs, reciprocal tariffs. These reciprocal tariffs came into effect on April 5th. The universal tariffs came into effect on April 5th. The reciprocal tariffs came into effect on April 9th. Why did he choose two different dates? Because perhaps he thought that the reciprocal tariffs are too extreme, and it was just a coercion tool for him, and not something that he was planning to keep permanently, because these tariffs do not make sense. So that's what he did. Maybe under market pressure, maybe under senators' pressure, we don't know, maybe other businesses' pressure as well. For sure, there was a combination of things. But what I'm saying is we should actually, look at what Trump is doing and saying carefully. And I think with China as well, yes, 145% tariffs. But he said yesterday, I really want to deal with China. So that means that we could have like an imminent announcement of some sort, start the beginning of negotiations.
Tariffs off, tariffs on,
yeah.
An offer. All right. Themos, do you agree? What do you see? What does your pattern recognition thing say?
Pattern recognition for those who have lived the 2015 experience in Greece with the known situations around the election and the referendum. For those who have experienced Brexit in 2016, there's always a moment in time where the infamous money tree stops growing free money, and then the promises require some tough consequences. So that's one pattern. Market-wise, I definitely agree with Nikola. This is a VAR shock in some degrees, although...
What do you mean a VAR shock? Maybe people won't necessarily get it.
So VAR shock is the equivalent of the Mike Tyson phrase, everyone has a plan until they get a punch in the face. So most funds will have assets and they will have hedges. And 99% of times, one offsets the other. But there comes this one occasion where one thing moves left and the other thing moves right. And when you have both assets and hedges and you're levered, you lose on both sides. And then you go to the cleaners. So that's basically
that's the VAR shock, okay.
So there's definitely elements of this. There's also elements of things that were highly forecastable in a way. The US has been on a multi-decade drive to isolate itself from the world. They woke up around 2005. They understood they got the short straw from global trade. Since then, they became a state-assisted monopoly on tech. They developed an enormous industry on oil, not without state kind of aid in many different ways. They developed a financial industry that benefited from regulation relative to the rest of the world. And up until the Biden administration, they had loaded China with tariffs and they had loaded lots of subsidies. So they were moving that way. I would also say that Trump had a unique chance to come in and do something that made a difference. In what way? In economics, tariffs is not an anathema. If you're playing a skewed game, a bad game, an unfair game, Bhagwati had said since the 70s, you should do tariffs. You should do subsidies. And the reality is that the world for the last few years, decades, but especially the last 3 or 4 years, has played a very skewed game with China subsidizing enormous industrial growth, dumping goods globally, and affecting growth in Europe, in the US, in other Asian countries as well. So he could have done something that is sector-specific, that is nuanced. He could have done subsidies plus tariffs. He could have done a proper trade policy. The problem is that in all this, you have a personality which takes us closer to 2015 in Greece, this type of kind of personalities, more extreme personalities willing to test orthodoxy to see if it works. And the problem with those personalities is that there's non-linearity. So again, the problem here is that although we don't need a China shock, China selling bonds, to explain what has happened to markets, it's not impossible that within an escalating trade war we could get something like that, right? If there is a mismanagement of a situation. If the US figures out that this is happening, how do they respond? So again, I don't think that these risks are super high chance, but I do think that these things are what the market is not going to forget about. And obviously, this does imply a slowdown. This does imply that the trade between the US and China for now is not happening. It's on a hold. This does probably include China dumping products elsewhere, which may mean trade frictions between China and Europe. We shall see. There's many different ways that this thing can play out.
But time doesn't help if things don't change. That's what your point is, that the likelihood of more problematic situations increases if we just stay on this path.
There's a lot. That's one thing. The fact that you don't have sound, senior, and good advice in the White House. You have, you don't have people. You have what is known as groupthink. The fact that you have a White House and other global policymakers willing to test whether something works simply by understanding whether markets break down or not. So all of these things are highly problematic as a setup.
Thank you. Panagiotis, you don't have to just talk and write about it, which, it's also important. You also have to face it in the markets as the chief investment officer, one of the largest banks in Greece. What does it all mean to you? What's your pattern recognition say here? Maybe it says nothing, but how would you describe the picture for all of us here?
I would like to take the opportunity to thank you for making me part of this panel and Delphi Forum, obviously.
Wait until the end.
My pattern recognition does not recognize this pattern unless you have to go back to the 30s. This is what I describe as an ancient curse, where all US assets go down at the same time. For any foreign investor or any traditional investor, no matter where they are, they know that if they own bonds and stocks, when their stocks go down, their bonds go up and soften the blow. When they're foreigners and they do not fully hedge the dollar, and by that amount they own some dollars, that also helps to soften the blow when it comes. None of this is working. Is that VAR shock that Themos was responding to. But this break of correlations, we have not witnessed it in a very long time. We had instances of those, but never the instance like the one that we had recently, whereby the equities dropped so much and the other diversifiers not only didn't help at all,
but let me just make sure that everybody understands that. You're talking about a trifecta here of equities down, bonds down, and the dollar down.
Correct.
Okay.
Yes. Typically, it's equities down, dollar up, equities down, bonds up.
Some sort of a different combination, not all 3 hours in the same direction.
Right.
Okay.
Right.
So
as much as I do ascribe to the idea that this market is not necessarily does not have a good signal to noise, i.e. all of these could be circumstantial, let's say, it is really bad and it is really intense in order for us to completely dismiss it as being circumstantial. And I do agree that you always have to be calm in the markets, otherwise you don't live long. But if you are to panic, it pays to panic early. So
you'll be standing up and yelling fire for all of us, or
not yet.
Not just about it.
Not yet, because there are silver linings around this, and I'm going to jump into another topic. The U.S. has been the happy recipient of capital from around the world for many decades, for good reasons. Big, deep, well-regulated markets, superior products, superior returns. And in exchange for that, the U.S. was running these big deficits. They were buying stuff from abroad. They forwent their industrial capacity to others that could do it better and cheaper. And they were the policemen of the planet, which had a significant cost for the U.S. But it was an equilibrium that we had arrived that was quite beneficial for everyone being involved. Right now, we are disturbing that. There is no guarantee that the new steady state is going to be great. We knew that the previous one was good. We thought that the US was getting the short part of the stick, although it doesn't look like it if we see it exposed. And we want to disturb that. We don't know whether we're going to get into a great place.
So hold that thought.
Yes.
Let me shift to the implications, not for everybody, but just for Europe and Greece in particular, because we are where we are. And I'm going to start with Tasos on that one. Can you set up the stage for us for either Europe or Greece or both?
Okay, thank you for the question. Let me start by making a point about Europe, which is our natural inhabitant. And the point to begin with is that if Donald Trump didn't exist, Europe should invent him. Europe has problems that are structural in nature and existed before all this trade war erupted. And these problems are a mix of a model of growth that is based on cheap energy, which doesn't exist anymore, heavy regulation, and hysteresis in know-how, in R&D, and getting in touch with the new developments in technology. So what Europe has to do in order to get out of this dead end, we know has been described already in the Draghi report, in the Letta report. It has to invest more, and actually he said how much more, 800 billion per year, additional to what it already invests, and has to reform the regulatory environment, in particular by introducing deeper integration in the capital markets and the banking union in particular. And all these things existed before the trade war. So if the lift of the umbrella of the American protection, or if the trade war is an excuse to start doing things earlier than before, it's a welcome development. Could you, for example, imagine Germany spending 1 trillion in infrastructure and armaments before all this erupted? Most likely not. How much will Europe be affected on the near term? I suspect not much. My basic scenario here, obviously the uncertainty is huge, but my basic scenario here is one in where negotiation takes place, so not the tit-for-tat strategy, which most likely will limit the impact on the European economy to something less than 0.5 percentage points in growth, as the European Central Bank has calculated it. You can live with that.
And what does this mean for Greece?
If Europe has to do some catch-up with the rest of the world, Greece has to do some catch-up with the rest of Europe. So it has to invest even more because it lags behind in investment, and has to reform its basic ingredients of competitiveness in terms of quality. How much more? Greece's share of investment in GDP, after having risen by 60% in the previous 5 years, now stands at 15.3%. In order to reach the average share of GDP, of investment in GDP in the Eurozone, which is 22%, 21% last year, it needs something like an 8% real increase in investment per year until the end of the decade. The last time we achieved that was in the 50s. So we have to put our act together.
I'm going to put you on the spot. What do you think is the probability that something like this at least begins in 2025?
It has begun already.
Or it continues, let's say, in a more intense fashion.
It has begun already in the sense that we have a very valuable tool, which is RRF. RRF, by its nature, is counter-cyclical. It doesn't depend on the financial conjecture, which is not very happy. And it acts also as a discipline mechanism for introducing more structural reforms, because these structural reforms are actually a precondition for dispersing funds. So some of it has already happened. We have to accelerate, actually, because RRF will not be there forever. It will end at the end of 2026. And not just we have to absorb all funds, but we have to direct them in the most productive uses, the ones that contribute the most to the change of the growth paradigm towards, new sectors like AI, green transition, energy, you name it. But also doing all the structural reforms that accompany this. On the longer horizon, we have to make the economic environment even more friendly towards private business, because there will not be tools like RRF forever. So we have to be competitive enough when this happens that we can be able to attract investment, and not just any investment. We need productive investment. We need more greenfield investment. You want to have enough of it.
You're going to give us some odds on this, that this is happening, the second part?
Well, not really.
All right.
FDI last year, just to give you the number, was 6 billion, which was increased by the 4.4 billion of 2023, but almost half of it concerned the real estate, and another 33% financial assets, which were mostly involved into NPE management. So we need more greenfield investment, which was near to non-existent in previous years. There have been improvements. There have been domestic efforts, but we need to redouble our effort now.
All right. Themos, Europe. What does this all mean for Europe, and if you have any thoughts on Greece too?
So I am a lot more pessimistic on Europe. I think Europe is being hit by two problems. The one is the US, which is very visible at the moment, but it's also it's also something that is very significant in the sense that the US has always been so important for Europe that Europeans don't understand it. Don't understand how much we have ridden for free on the back of American military and financial reassurance and stability. But it's not just the US. For years now, China has stated its goal as replacing Germany in a techno-nationalist hub globally in terms of industrial production. The US has gone through a shock like that in the early 2000s and became deindustrialized. Germany is on that path, basically, right? Now, I do fully agree with Tasos that had it not been for Trump, we would have not woken up at all. In the sense of, if there hadn't been that Friday where he kicked off Zelensky from the Oval Office, you wouldn't have had, literally wouldn't have had, the reaction from Merz literally the next week. And that's all great, but whatever investment comes in, it needs to be seen against the counterfactual of where growth would have been had it not been for that investment, right? And let me put it like this. The RRF was bigger and dispersed over a shorter period of time in Europe relative to the German infrastructure package, the infrastructure package. But we are really trying to see the impact of that in aggregate growth. Imagine if it hadn't been there, basically, right? Now, Draghi has also spoken beyond the investments that Europe is an incomplete union. We have a union for goods, but we don't have a union for services. The only service that there is a Digicom agreement on a common market is telecoms. The fact that we roam for free within the EU. The non-tariff barriers we have on European services cost 45%, the equivalent of 45% tariff on services. We don't have a banking union because we cannot agree whether the German banks can buy Italian bonds at a similar capital. We don't have a capital markets union, which means that if a company wants in France to raise money to go into a European market, they cannot do it. They cannot raise money, they cannot go into a European market. They can easier raise money to go to the US market, basically, right? And lastly, we're moving closer together politically through the lack of the military umbrella in the US, the fact that NATO now becomes, it's not just Trump. The US really doesn't see Russia as an issue anymore. The issue for the US for the next 20, 30 years is China. They want to direct resources and military there. The fact that Russia is a big issue for us in Europe. The fact that we don't have an umbrella does incentivize us to spend more. But do we have a common foreign policy? Is our foreign policy in Greece the same as Poland's, basically, right? And can we find common contours like that? Now, I don't want to present it as doom and gloom. This situation does benefit Greece because it will allow more fiscal space, so the government will spend more. It will probably reduce interest rates, so people can borrow more. And the balance sheets of Greece are starting still from a point where there's excess fiscal discipline and there's under-levered households. But interesting phenomena are popping up in Greece as well. We used to be so much pro-austerity. Now there's strikes about more salaries per year. We used to be very much pro-investment. Now we don't like real estate. We don't like tourism. We want some other kind of investment, basically, right? So we really need to open up our eyes, understand that the geopolitical setup is a very difficult one. Near term, it's good for Greece, but whatever Greece can do to come closer to certain developments within core of Europe, they need to do it now.
Can I ask you any implication about European assets here? That you
when I look
feel more
at European
about?
bonds, for instance, and I see that in the medium term, the European bond markets expect ECB rates to average out near 3%, I find that crazy, right? When I look at the euro dollar and people extend it to think it's a safe haven, when only 6 or 7 years ago, the Germans were willing to destroy the European Monetary Union over a budget dispute with Greece worth 500 million, not billion, million, I find that equally uncertain, basically, right? Now, European equities will offer opportunities, I would say, but one needs to be very thoughtful about where government money will be spent.
That's not because I told you to say that, right?
That's also
okay.
because.
All right. Nicola, assets. What should we be looking at here that affects, I guess, Europe or any other big move that you feel confident about?
Yeah. I mean, clearly, when you look at flows, there has been a big change in Europe. in the European equity space. Just to give you an idea, in 2024, we had 9 billion entering European equity ETFs. In 2025 year to date, we had 35. The last time we had
a big shift.
Big shift, but
is it sustainable?
Again, is it sustainable? It depends what leaders are going to do, because clearly we lack leadership in Europe. Clearly, as Draghi said, the European Union is not a proper union. We don't have common bonds. We don't have common projects. When I look at this 800 billion defense project or budget, that is really depressing, because there are no common bonds. Even the 150 billion component will eventually, is loans that will eventually fall into the national budgets. When in such difficult and critical times for European defense, we cannot come up with 1 trillion of common bonds to create common defense projects, that's really disappointing.
So you think, let me just be a bit blunt on this, do you think the fact that suddenly Europe is back markets-wise in terms of outperformance against, let's say, US equities, is that a mirage, you think?
I think there is no convincing structural story in Europe without, good leadership. I don't think at the moment.
So that relies, you think, on bad leadership on the other side so far?
Well, the issue is, again, for Europe to benefit from the other side's bad leadership, it needs to do something.
Still?
Yeah, still. And again, look at this 800 billion defense announcement. It's extremely disappointing.
Would you recommend to your clients to go the other way?
No, at the moment, for as long as the US remains under pressure, even small flows can have a big difference. The European equity market is small. It's not even remotely comparable to the US. Just to give you an idea, November, December, we had $150 billion each month going into European equity ETFs. And now we are talking about $35 billion going into European equity ETFs in 3 months.
Right.
So 10 billion a month. We are celebrating it because it's the strongest pace of inflows into European equities since 2017. But again, we are not we're not talking about a lot of money. So you can have, with small flows, a big impact because the market is smaller. But I don't believe here that Europe is convincing as a long-term structural story. Because for that, again, I'm not saying a complete fiscal union, but if we cannot see 1 trillion of common bonds to finance defense across Europe, then that's really...
It goes to your earlier point about let's not extrapolate too much here.
Yeah.
All right. Panagiotis, what do? You have a...
I'm afraid that I will have to disagree about Europe, and I will say that aloud. Europe is where it is because the European Union happened because Europe was tired of being ping-ponged between US and Russia in the past. They created the European Union. Now they have a very strong external impulse that reminds them why they have come together. The biggest thing that we need to take into account is not the absolute numbers, but the fact that the old mantra of austerity is out the window from the German mouth, from the ones that have been enforcing that for all this time. This is not insignificant.
How do you express this in the markets? And do you just wait?
I do. I do believe that the US is not going to be the sole destination for global capital like it has been over the last couple of years. And some of that money can potentially go to other jurisdictions. If you look around, there are not that many big economies that can take that kind of money. Europe is one of them. I'm not saying it's going to happen for sure, or it is guaranteed that this is going to happen, but we have a chance.
And where do you
that chance
express
is
that?
not, yeah, that chance is not insignificant. You express it with European government bonds, for example, or European equities, or any other European asset that you can, including the currency. I'm not going to be making any valuation arguments because in currencies, you know better than I that it doesn't matter a lot. But it does make a difference when you have structural shifts from an overplayed card of global reserve, like the dollar has been, into one whereby, by coincidence or by choice of the majority in a democratic nation, you have a leadership that is questioning the very foundations upon which all these trusts have been built for such a long period of time.
So I guess it's go Trump. All right.
No,
great.
I say that I agree that Trump has a chance to make Europe great again before he makes America great again.
Great. Okay. Thank you very much. I really appreciate your participation, and let me invite Antonis Papagiannidis for the next panel. Thank you all.